Hello, it's Mark Barrett here from Property Tax Advice, Expat Tax Advice. Topic today is CT61. This is the taxation of interest payments made by your company. So this is relevant only those with a company. And just going to run through what you should be doing when you have a financial investor, so someone who's loaning money to your company. So the issue is very simple. The interest rates that you pay to your financial investor must be at commercial rates of interest. Now, the good thing, of course, is that HMRC never tell us what that means, commercial rates of interest. What they're trying to achieve here is to say, look, you can't start to pay someone a ridiculously high level of interest. In effect, if you did that, you'll be sharing profits with that person, and therefore they would be a trader with you rather than simply a cash investor. The reason for that is any interest that you're charged is tax deductible in your company. If it's tax deductible in your company, then of course, if you've given someone 50% interest rates, who the heck gives 50% interest rates, but 50% interest rate, then obviously your profits are lower in your company, therefore your tax bill is lower. And HMRC don't want to see that happening. They will tax the recipient of that interest as though they're trading with you and tax them on income tax and national insurance on their interest receipts. So first of all, keep your interest at sensible levels, please. That's particularly bad consequences for that for you, the person paying the interest, the company paying the interest, if the investor is abroad, because the HMRC can't tax that person who's abroad on the interest they've received, their share of your money, and therefore they can come back and tax your company on the tax that the investor should have paid. There's some rules on that because slice of the action. I'm not going to deal with that in detail today. If you need advice on that, obviously come and talk to us. And you've got all our contact details. So having established that the rates have got to be commercial rates of interest, now we're going to deal with CT61 itself. Now, what is CT61? In effect, in circumstances, and I will be running through all of these in a moment for you, you will be deducting tax from the interest you're paying. You deduct tax at 20%. When you do that, you have to register with HMRC to deal with CT61. When you're paying interest to your investor, you deduct the 20% in tax from them, and you have to give them a tax certificate on every payment. And then once a quarter, you hand over all that money that you've deducted over to HMRC. So that's the essence of CT61. It's like paying tax at source, right? Like PAYE, CIS. These are taxes at source. So that's what you're doing here. So CT61 rules. Okay, slightly complicated, and therefore I put an image up. So CT61, how this now works is that if you're paying interest from a company to a company, so your investor is a company, they've loaned you the money, you're paying that company interest from your company, CT61 does not apply. That's great news. If a company has loaned money to you as an individual and you pay interest from the individual to the company, again, CT61 does not apply. Now, in both those situations, why? Well, companies are deemed to have greater reporting requirements. They're not going to try and hide. They're not going to not file a tax return. Every company has to file a tax return. Therefore, it's beholden on the investor, who is the company who's loaned the money, that they will declare the interest that they've earned. Okay, so let's go to scenario number 3. What about if the individual is paying interest to an individual? So an individual has loaned money to you personally. CT61 doesn't apply. Now, what's quite important, we'll get to that in a moment. That's a route out on a problem in a moment. Okay. So now we're left to the fourth one. Fourth one is if a company has borrowed money from an individual. Now, HMRC is very worried, of course, because they're saying, well, individuals might not know they've got to file a tax return, might not complete their self-assessment. Therefore, they want to tax it at source. So we've got two scenarios here now. If the contract period, and not only the contract, but actually the reality of that contract, was that the money was only loaned for less than a year, CT61 doesn't apply. However, if the contract was for longer than a year or more, or even if the contract was for, say, a shorter period, let's say 9 months, but the reality was that you didn't manage to pay back the capital within that 9 months, and actually it extended to a year or more, then CT61 does apply. I'm talking to you how we're going to deal with this CT61 a little bit more. So you've got to look at your contract. What's really important with all of this is make sure your paperwork is straight. I know the accountant keeps saying that. Property entrepreneurs, you really must engage with firms like ours to deal with your enhanced company secretarial, because it's the company secretarial work that deals with all of these contracts. There is a loan agreement. There is a board minute that says you are borrowing this money. This is the interest rate you've agreed to pay. And there are regulations about how you do those. Get your paperwork straight, please. Okay, so CT61, let me remind you, you will be deducting interest at 20% and paying it over to HMRC on a quarterly basis. You'll be giving the investor 80% of their interest in cash and a certificate for the 20% of tax you deducted. And there is a format for that tax deduction certificate. So now the problem becomes, what happens if your cash investor is frightened now by this idea that they're going to tax deduct it, etc.? So my usual explanation, let's imagine that is dear old Auntie Maud. Okay, dear old Auntie Maud. Pensioner, doesn't have to pay a lot of tax. She might not have much of an income. She loans money to you because she wants to support you in your business. That's great. But if she loans it to the company and it's for a year, in reality, in contract or in reality, you'll have to deduct the 20% interest. Auntie Maud now is a bit worried. So have Auntie Maud lend the money to you as the director of the company. So now it's interest paid from you personally to Auntie Maud. Okay, individual to individual. There's no CT61. What we do have, however, is that you now have to loan the money to the company. That's an individual to a company, but that's okay. You're a company director. You do self-assessment, I hope. And therefore, you will deal with the interest that is the taxes deducted on the interest. How will you deal with it? So let's imagine. Let's imagine you borrow some money from Auntie Maud. You're giving Auntie Maud £1,000 a month interest. I mean, a big number, but let's imagine that number. Fine. You loan the money to the company at £1,000 a month interest. The company pays you £800 with a certificate for the £200 worth of tax that's been deducted. And that happens all year. Great. Now you complete your self-assessment. On your self-assessment, you say, yeah, I did receive gross £12,000 worth of interest, but I had a cost for that. The cost for that was £12,000. You haven't made a profit. You haven't made a profit. You don't pay tax. You hand over all your certificates to the accountant. The accountant says, oh, thank you very much. We've got 12 certificates, each of £200. Taxation will claim that tax back for you. So we've now moved all of the tax compliance activity to you as the director and still let you borrow the money from Auntie Maud. That's particularly relevant also for an overseas investor. But be careful with that one, overseas investors. So now we'll go back to look at the overseas investor. Now, the problem with the overseas investors, and we deal with a lot of them through expat tax advice and obviously our company property tax advice, where we've got people from abroad who are loaning money to our clients in the UK. You still have to deduct tax from that money. And let's imagine your investor is in Dubai, Saudi. They're not used to paying tax, they don't like that principle. Well, that's fine. It is possible that under the double taxation treaty, again, come and talk to the accountants, and we look at the double taxation treaty and say, can we pay interest abroad and not have to deduct interest? It's possible. On the OECD model, the typical double taxation treaty, it's not possible, but subject to the double taxation treaty specific to the country that you're dealing with, you may be able to pay that money gross. Here's the rub. You, as the borrower of the money, cannot make that application to pay gross. It has to be the lender who makes the application. So, super quick run through of CT61. Lots of people have asked us questions about it. I'll put this up onto our website, and obviously, if relevant to any questions we're asked in future, I will share it. So hopefully that information has been useful to you. At the end of this video, last few frames of the video will be our contact details. You're welcome to contact me or any of the team here at Property Tax Advice, Expat Tax Advice. I know that most of our clients at Riverview Portfolio, our principal company, they're not borrowing money from individuals for their company, but it can happen. Certainly can happen from the director loaning money. Remember, that is very applicable if you're charging interest. So hopefully this has been useful to you. If it has, please subscribe to the channel. Please give a thumbs up to the video and a nice comment. If you need any help, you've got our contact details. Thanks very much. Bye.